Good evening, ladies and gentlemen, and welcome to our class on retracements and reversals. I'd like to wish everybody a happy and healthy new year, and hopefully you had a good holiday and you're ready to start out with a very active trading year. And tonight's webinar is brought to us by Trade Time, one of the leading providers of CFD and forex trading. They offer a very unique trading platform and a trading environment where they customize or allow you to customize everything from your account name to the dashboard to your trading platform to what your objectives are, what your personality is. It'll fit with the emails you get, what the information you get. If you're aggressive and you want very aggressive signals, they will provide everything based on your personal desires. In fact, before you even open an account, you set up exactly how you would like your account to act and how they would like to how you like to be dealt with. You can select from a full range of options when building your personal trading account, and you can change it afterwards. They give you a whole slew of trading tools, from daily analysis to weekly reviews to articles to live signals. They have an extremely robust platform that is great to use, friendly, dynamic, and it has been set out with you in mind. It's a very easy, efficient platform, and all the information you get is right at your fingertips. So if you want, go to www.tradetime.com and open a demo account or open a real money account with them and start trading now. You'll be amazed at how nice it is. The signals you get are pushed right out to you at the platform while you're trading. But not only do they tell you what to trade, they give you the direction, the position, your first objective, your second objective, your third objective, and where to put your stop loss. And you also see how many other traders on the platform have traded with that signal. So give Trade Time a shot and go to www.tradetime.com and try out their next generation of trading platforms. Now, tonight's class is being recorded, and you can access it in about 24 hours by going to www.investing.com, where you signed up for the webinar, and go to the Education tab and then locate Webinars on Demand. So welcome to our class on retracements and reversals. Now, the ability to point out the difference between a retracement or pick out the difference between a retracement and a potential reversal is a great tool in trading for your trading arsenal. Many inexperienced traders, along with some of the most experienced traders, are still unable to detect the difference between an asset's retracement or a potential reversal. Now, it is crucial that we understand how a trend works, okay? Because if you know the rules of a trend and you believe in how a trend works, you will understand that retracements are part of an asset's movement, and you won't get upset with them. In fact, you will like to see them, because when an asset retraces means it is going on a very good trend. It's supporting how a trend should act. Now, retracements are just momentary reversals that often occur during a longer trend. Unlike reversals, retrends show a continuation of the opposing trend within a target's asset. As you see in the picture, there are a couple retracements that take place and occur throughout a prolonged period of time. Now, a proper trend, a well-developed, strong trend, will show push, ease, push, ease, push, ease. Now, push. Now what happens is when we go down to the ease and it doesn't ease, okay, we're going into a reversal. Because what we do, if you notice on these pushes and eases, we're constantly making higher highs and lower highs, or in a downtrend, lower lows and lower highs. Okay. And remember, one is just the reverse of the other. But each time an asset pushes up and eases back down, it should only ease no lower than the previous low. the swing low, and then push up. And this gives you a very well-developed trend. And I'll show you, I've got a live chart of just the euro US dollar. We'll just go over there real quickly for a second. And let me get my marker off of here. I don't know how it came up. And we can see in this trend, pushes and ease. Now, this is a 1 hour chart, but we see how price pushed up, eased back down, pushed back up. Now we need it to ease down, okay? Because otherwise, price cannot continue in a straight direction. There's always gonna be a time when buyers have bought up and they need a breath, okay? You know, you just don't have this straight uphill run. It's like imagining a guy who's running a race and he runs full out and doesn't pace himself, and he's, you know, and he's running to a mountain, coming down the next slope, running up to, you know, when he runs up to the top of that hill, he needs like gravity pull him down a little bit so he has the energy to move up the next hill. This is how a well-developed trend will work. And when you understand this, you don't panic when it eases. You're happy, and it gives you some trading ways to successfully enter a trade. But you need to see these push, ease, push, ease, push, ease, push, ease, push, ease. Okay. And again, the more developed they are, the better they are, the more you can use that trend to follow that price pattern. So let's go back to my PowerPoint here. Okay, so a retracement is simply a momentary reversal that occurs during a longer trend. A reversal, on the other hand, are temporary changes in an asset's trend that occur over a short period of trend. Oftentimes, these reversals can last minutes, hours, or days. It just depends on what time frame you are utilizing with your charting solution. Reversals are oftentimes drastic and do not represent a long continuation of the opposing trend during the asset price action like seen in retracements. Okay. Now, there are some fundamental ways that you can see or ask yourself, or questions you can answer to determine in the move whether it is a retracement or a reversal. You can also use things like looking at the volume on the bottom of your chart. But first of all, you'll see volume. You'll see if it's a retracement, profit taking by retail traders, small blocks of trades. If it's a reversal, you'll see lots of volume coming in by the institutional traders, because they're either buying in the opposite direction, selling or buying in the opposite direction, or they're getting out of their trade. If you're looking at money flow. Now, chart patterns. Few, if any, reversal patterns usually are limited to candles. Most reversal patterns don't really help you that much, except certain patterns like bullish engulfing and bearish engulfing patterns, or if they're reversals, you'll see true reversal signals like a double top, a double bottom, head and shoulders. Time frames. You can use overlapping time frames. Also, a very big important question is fundamentals. Was there news, an economic event, a release that just happened at that moment, or is the market anticipating something happening? You know, are they preparing for the Federal Reserve or a speech by Mario Draghi? You know, because it's not really a true replacement or a retracement or a reversal if it's the market's being affected by speculation leading into or up right to an economic event, because you don't see a reversal because the economic data came out and is really weak, because that's not a reversal that occurred in an uptrend or downtrend. That is something that was forced by an event. And candlesticks, you'll see a retracement pattern in what we call indecision candles, spinning tops, dojis, small body candles. And then you also see reversal candles. And these include bearish engulfing, bullish engulfing, three white soldiers, three black crows, or other similar patterns that you can see in candlesticks. So you can use a set of predetermined questionnaires that you can look at while you're looking at price movements to decide or help you decide whether it's a reversal or a retrend. But whenever a price reverses, most traders and investors are faced with a tough decision. And they have three options. Hold throughout the sell-off, which can result in a large loss of the retracement, turns into a larger trend reversal. Sell and rebuy if the price recovers, which will definitely result in money wasted on commissions and spreads, or missed entry points. This may also result in a missed opportunity if price recovers sharply. 3, sell permanently, which could result in missed opportunities if the price recovers. By properly identifying the movement as either a retracement or reversal, you can reduce your costs, limit your loss, and preserve gains. So traders have an expression for attempting to pick a market top or bottom, and they call it trying to catch a falling knife. Okay. The fact is we can't do this, and we have to be aware that retracements happen and so do reversals. We don't want to catch it at the very second it happens. Can't happen. But we want to be prepared when one of the two is developing and be prepared if it's a reversal. And we want to be out of the market before we lose our shirts. So retracements are healthy. If you get this built into your head that retracements are a part of an uptrend and are strengthening that uptrend because they are how they are supposed to be working, then you won't get panicky. So the market in general can become tired of moving in the same direction. It takes a lot of work and money to send assets to higher highs. When the price gets too high, buying pressure runs out when the money dries up. When demand dries up, price begins to fall and causes the chart to head south. This causes security to become more appealing to prospective buyers. So imagine the euro's moving up. It's at 118.5 hypothetically. Nothing to do with today's prices, a number that came off my head. Okay, and the euro's trading at 118.5. Well, the markets, we see it move up to 118.7. Well, the buyers have bought up at 118.5 and they don't see any more opportunity. So the price pushes up to 118.7, but there's no more buyers at the moment because they don't see any more opportunity, and the price falls back to 118.55. If it doesn't fall below that, and the buyers start to re-enter the market because it's down at a price point where they think it's a good price, and they re-enter the market at 118.55 and push it back up again. That's all it is. The buyers are waiting for the price to come down, and then when they push it up, and they push it up to 118.9 or 118.8 or 118.85, again, they're going to say, okay, it's topped out. Buyers run out because they wanted to buy at 118.5, but it doesn't come back to 118.5. It comes back to 118.59 now, and the buyers say, okay, well, this is the best price, and they come back into the market. And this is what forms your very healthy retracement. So what I've just described is a retracement. Retracements are healthy functions of a solid trend, and they are the proper time to enter a position on a trending asset. So in other words, when you see this retracement and you see the price starting to move back up, that is the proper entry time. We won't be able to pinpoint the bottom and we won't be able to pinpoint the top. But when you want to buy into an asset, you should be buying as it comes off of the retracement, to take that and ride that asset all the way up. Okay. Because each push might be a much larger push than before. So you can see that after retracement, a healthy part of a trend, the asset was unable to push to higher highs, and instead the security rolled over and created a lower high. So in other words, here we had the asset moving back up off that retracement. But when it did that, it wasn't able to form higher highs, and it came back down to form a lower low. So now what we're getting is a bearish reversal because it's losing its momentum. It could not continue up. So it came back down and it formed the new high. But look at that. The new high was lower than the previous high. So that's telling us the buyers are pretty well petered out. And this is called a reversal. Okay. A lower high is unhealthy, but it's not the end of a bullish trend. It's possible that after setting a lower high, the asset could retrace again, never setting a lower low, and then push above the previous high to a higher high. A nail in the coffin for a bullish trend is the establishment of a lower low. Now, when we talk about lower lows and lower highs, if you're not exactly sure what they are, you should come to a class on trends and understanding trends. But they're based on the swing low and the swing high. That's the lowest price that asset reached in that current price movement, or the highest price it reached in that price movement. So we have lower lows, lower highs, higher highs, and higher lows. And we talk about them all the time. They're called LLs or LHs, or lower highs and lower lows. Now, let's add some guidelines to help you with some rules here. Reversals are defined as a change in the overall trend of a price. Okay. So instead of being a temporary retracement, they are a reversal in the price pattern or the trend movement. It's when an uptrend switches to a downtrend, a reversal occurs, or when a downtrend switches to an uptrend. This is the reversal. And what we notice here is higher highs. So this form could not form a higher high, and it came down for a retracement, and it kept forming lower lows and moving down. It could never move back up above this point where it was. And even the high here, the highest point of that asset, never could, and it went into a reversal. So this is where we see the reversal. But we couldn't be sure it was a reversal, although if we look in the uptrend, push, ease, what happened when it pushed up here? It was not able to come above the previous high. It went into a bunch of congestion, and then it did try to push back up again, and it just could not maintain it, and it fell. So it wasn't push and ease, push and ease. It was push and ease, and then push, petered out, and we went into the downtrend. So you can actually see this fairly easily, but you have to decide, you have to know what point you can deem this a reversal as opposed to a retracement. So when faced with a possible retracement or reversal, you have three options. One, if in a position, you could hold on to your position. Because remember, you only have three possible things that are happening. Forget the retracement reversals. You can be in a position and continue it on. You could be looking to exit a position, or you could be looking at starting a new. So you could be in, getting out, or starting, or not trading. So getting in, getting out, doing nothing. So those are your three possible decisions you have to make. So the first one is if you are in a position, so you already have the asset. You bought it at a lower price that has been moving up steadily in a well-developed trend. So when you come to this point and you're not sure what it is, you have a couple choices. You could hold on to your position. This could lead to losses if a retracement turns out to be a longer-term reversal. You could close your position and re-enter if the price starts moving with the overall trend again. Of course, there could be a missed trade opportunity if the price sharply moves in one direction. Money is also wasted on spreads if you decide to re-enter. So, in other words, we bought in this asset somewhere here for some reason, whatever other reason. I don't know why you bought in this asset. It pushed up, it did beautifully. It pushed ease down, pushed back up. Now, when you come to something like this, you have several choices. You're not sure what it's going to do. If you can believe in the way a trend moves, you could hold into it because you want to maximize your trade. You want to minimize your risk, but maximize your trade. So you don't want to exit every time it eases down, because if you exited as it was easing down, yes, you would have locked in some profit. But if you would have stayed in the market, you could have ridden it out to somewhere in this point. Even if you got out here at the reversal, you would have still made handsome profit. But if you got out here and every time it eased down, you exited the market. So you entered here. You made profit here because this is where you're now. But you didn't make profit there because you paid the spread on both sides. And then you want to re-enter the market. Well, where are you going to be? You're never going to be able to nail this point. So you're going to re-enter the market here, and you would have lost all of that price movement there and been paying the spreads twice over. Now, if you would have fully believed that this was a retracement and this was a healthy retracement, you could have ridden out the market to here. And retracement, here it's a mess. You could have panicked here, but if you would have panicked there, you would have still been far ahead of where you would have exited the market earlier. And if you stayed in the market here to the reversal, you still would have been ahead. So you have to be able to decide where to exit the market, not panic buy and not panic sell. So you're faced with several choices that you have to make. And this is why you have to be able to believe. I'm just trying to get my markers off here. Uh-oh. Hold on one second. There we go. So you could close permanently. This could result in a loss if the price went against you, or a huge profit if you closed at the top of a bottom, depending on the structure of your trade and what happens after. Now, I've seen all kinds of things, and I have all kinds of trades. Sometimes I'll push up, and as it pushes up in my favor, and then I see the beginnings of a retracement, I'll sell half of my trade, lock in my profit, and move my stop loss higher. And be prepared. Because reversals can happen at any time, choosing the best option isn't always easy. Now, somebody asks, how do you know when it's actually a reversal? Well, you have to combine this with other technical analysis, but the minute it starts making what? Lower lows, if it's an uptrend, you know it's probably moved through a reversal, but there's no firm law. There's no guarantee that it's always going to happen. But the following are the most popular tools to use to do this: Fibonacci retracements, pivot point support and resistance, trendline support and resistance, chart patterns, and other strategies. There's no way to only predict. There's ways to get prepared. There's ways to build your trading so you're aware of them, but there's nothing that's going to guarantee you that that retracement's not going to flip into a reversal. But if you're looking at volume, that's going to help give you some indication. If you understand that a trend should work in push and ease, lower low, higher highs and higher lows, moving along, and you see this pattern fading, you know that you probably have something happening in the market. You can't guarantee yourself, but you can prepare yourself. So Fibonacci retracements are an excellent tool for calculating the scope of a retracement. Now, Fibonacci will help you figure out where that retracement should go to. So if you have the Fibonacci's on there and you're seeing it at a specific Fibonacci level, or you have support and resistance levels on your chart, or you have a strong trend line on your chart, and you see it breaking any of those levels, that's most likely telling you it's moving into a reversal and not a retracement, because it's not. A retracement should bounce off of a Fibonacci level. If it's not 31.6, it come down to 50 and bounce off of that. Okay. Each time it eases lower than one, Okay, you need to be prepared for other, but you can't panic because there's no guarantee it's only going to go to 31.8 or 31.6 to the Fibonacci and not fall to 50. You have to just be prepared. To use them, simply use Fibonacci retracement tools and draw a line from the top to the bottom of the latest impulse wave, and it'll give you those levels. Fibonacci retracements are excellent tools for calculating the scope of a retracement. They are most widely used in the forex market, but can be used in the stock market also and for commodities. If you're trading CFDs, they work great. To use them, simply use the Fibonacci tool, retracement tool, and draw a line from the top to the bottom of the last impulse wave. So if it's an uptrend, you draw it from the top down to the bottom. If it's an downtrend, you draw it the reverse. In most cases, retracements will stay at 38.5 or the 50% level. If the price moves below these levels, then a reversal may be forming. You can use pivot point levels, support and resistance levels. Pivot point levels are also commonly used when determining the scope of a retracement. Most traders look at the lower support at the R1, R2, and R3, retracement resistance level 1, resistance level 2, and resistance level 3. If these are broken, then a reversal may be forming. Okay. Third, you can use trend lines, because if you're moving in a trend and if you have you've identified a trend and a trend line are different things. Here we've identified a trend. Price is moving up, push, ease, push, ease, push, ease, push, ease, push, ease, push, ease. So guess what? This trend line, which is drawn in an uptrend underneath the prices, connect 3 or more points in common to validate it, now is valid. Now what happens if this line ever breaks that trend line? Guess what? It's now formed a lower low. Okay. So that tells you it's most likely going to move into reversal. If in a downtrend, you have the exact opposite scenario. You can use Bollinger Bands. There are lots of technical tools that you can use. This is what you want to incorporate in your strategy, decide which one works best for your decision making. You can use 2 or 3 of them if you wish. Chart patterns, which are well known, like head and shoulders, work extremely well. So chart patterns have an established definition and a criteria, but there are no patterns that will tell you with 100% certainty where a security is headed. After all, the richest man in the world would be a trader in that case rather than an investor. The process of identifying chart patterns based on these criteria can be subjective in nature, which is why charting is often seen as more of an art than a science. But a head and shoulders pattern and the break of the neckline, which is actually the support line, when you have this pattern, is pretty good to explain that, to point out that you're going into a reversal. So you have to decide what reversal patterns you think are best. Then we have chart patterns. The 2 most popular chart patterns are reversals and continuations. A reversal pattern signals that a prior trend will reverse upon completion of the pattern, while a continuation pattern signals that a trend will continue once the pattern is completed. These patterns can be found all across different time frames. But look, when we look at patterns like triangles, we know that we have built up momentum as we move into the center of the triangle. We're going to have a breakout one way. We're either going to have a breakout up or a breakout down. If that price is moving up and breaks downward, that's telling you have a reversal. If the momentum's built up as you're getting to the center triangle and it breaks out in the direction of the trend, then you have a continuation. So remember, technical analysis is a study of historical price performance in an effort to predict future price performance in chart patterns. Price is the only accurate measure of investor sentiment. It is the intersection of supply and demand. Investor sentiment is at least possibly a more significant determinant of price than fundamental factors. Now, Once you understand how a trend works, and once you can identify these pushes and ease, these support and resistance levels, and get a trend line in here, the more you can delineate what's going to happen. So triangles are among the most popular chart patterns used in technical analysis, since they occur frequently compared to other patterns. The three most common types of triangles are symmetrical, ascending, and descending. These chart patterns can last anywhere from a couple weeks to several months. Symmetrical triangles occur when two trend lines converge towards each other, and the signal only that a breakout is likely to occur, not the direction. Ascending triangles are characterized by a flat upper trend line and a rising lower trend line, and suggest a breakout as higher is likely, but again, it doesn't tell you the direction of the breakout. So if you're watching this and seeing a triangle or a wedge or a channel developing in your price charts, then you can be prepared for when you see the breakout, and if it breaks in the direction of the trend, you know what's happening. If it breaks out against the direction of the trend, you know what's happening. So I love trading from triangles. I always say that in any trading strategy, you should only be exposed to the market when absolutely necessary. That is, whether it's a strategy running on daily intervals or monthly intervals, a trader should not stay in the market longer than needed because it leaves room for the unexpected. This is a firm belief of day traders, especially CFD traders, not even day trader, is get in and get out. Don't let your trade run that long because anything can happen. So if you can find fast profit, not fast meaning minutes, but if you can get a trade and get out of it, okay, as opposed to doing a 3 or 5 day, because you have no idea what Donald Trump's going to do. You have no idea when there's a terrorist attack. You have no idea what's going to happen in China, and you have no idea when an economic event is going to come out and miss the expectations. So you can use a retracement pattern or a good solid trend, and then take advantage of the momentum or momentum strategy that comes through triangles and trade that momentum breakout, especially if it is in the direction of the current trend, to take advantage of that momentum. So when a triangle does appear in a well-developed trend, what is it trying to tell you? Okay. Is it a reversal or a retracement? Well, here you can see on my chart, we have a well-developed, beautiful triangle, and it broke out in the direction of the current trend. And then look at that, it formed a second triangle that was just as easily traded. So in order to identify a symmetrical triangle pattern, we have to watch for 4 unique yet symbolic conditions. Okay, somebody just asked me, do I know of anywhere on the internet where he can get a tool or they can get a tool to identify triangles? Nope. Okay. Everybody today, and I'm going to stop for a quick second here and not chastise this person, but comment. Everybody today, because all of this stuff is given to us by the internet, not free, necessarily free, but we have computers, and everybody wants to use these tools to do everything for them. And the fact is, old-fashioned charting by hand. Now, today we have these great computerized and Java charts that'll do anything for us, but actually finding triangles, finding patterns yourself makes you a better trader, because you not only see them, you found them. They're part of you. You felt the development because you know when they've actually, how they've developed, because you look for them, you watched them, you've seen them happen. When I have lots of friends who use Japanese candlesticks, and they couldn't tell me what pattern is developing. They don't notice a pattern. They get alerts when some tools told them there's a pattern developed, and then they trade from that pattern. Well, you know what? I've been charting by hand for 40 some years, and I can tell you everything's happening with my assets because I can feel it in them. I can feel the patterns developing. I can feel what's going on. It's almost like having children. And you know your children. You know when they walk in the house and they have a smile. You know when they walk in out. You understand exactly what's happening. Where if you just came home and you had a nanny, and you got home from work and you asked the nanny, how was the kids today? And they said, oh, they were fine. They did their homework. You know nothing about your kid except he didn't get in trouble and he did his homework. And this is what by charting and understanding how to locate these things and understanding the parts and actually seeing them develop is very crucially important, because you get to feel how that asset is moving. And it also means to do this, you have to spend more time with that asset, and you can't be trading hundreds of different assets at one time. And this is the other problem that a lot of traders have, is their choice of asset trading is all over the map. My first years in the market back 40 years ago, I was only an agricultural trader. I traded 4 different agricultural assets, commodities, and that was it. And I spent all day charting, all day getting the information, all day mastering them. But to be honest with you, if you traded only the euro and 4 crosses, and you knew everything about the euro and understood how all of those were working, or you only wanted to trade cryptocurrencies and you understood Bitcoin, Bitcoin Cash, and Bitcoin Gold, and maybe Bitcoin against Ethereum, you'd be a master of them. But you can't possibly successfully jump from Bitcoin over to gold, over to crude oil, and back to the euro and back to the pound because some headline newspaper told you something or somebody grabbed your attention. Now, there are certain trading systems that pay no attention to an asset and only look for a specific type of something happening in a chart. And that's also a very good system, because then they don't care what asset they're trading. They pay no attention. It's when this pattern, these 3 things happen, it signals me to trade that asset. Okay. That's also not a bad situation, because then you're the master of that trading scenario. But you have to decide how you're going to be, what you're going to do, and how much you know about an asset. So these tools that they offer us are great, but we can't be dependent on them. Now, with chart patterns, okay, or with when we see an asset trending and we're looking for signals, a buy signal comes at a very specific time. That is after a pair breaks above a correction pattern and the oscillator, in this case, MACD, moves back above the 0 and descends back into buying territory. A symmetry of a triangle is what helps us determine our limit. The symmetry does not have to come from the shape of the symmetrical triangle on the upward move. In fact, the only one element should be symmetrical, and the high from where the price breaks the correction pattern and moves into a retracement should be identical to the high of the triangle. So the chart shows that a pair has continued above its point B. And then we can take advantage of this momentum to trade that asset. Now, there are all kinds of crazy stuff out there in the market today also. This is one I found when I was researching for this class. And this was a whole strategy somebody came out there using. I don't even know time. I thought it was so absurd I put it into this class. And he calls it a sushi roll. And it's finding an asset that's uptrending or downtrending with strong retracements, push, ease, push, and he would buy in every push and ease. So it takes a period of 10 bars where the first 5 bars are confined within a narrow range of highs and lows, and the second 5 bars engulf the first with both a higher high and a higher low. The pattern is similar to a bearish or bullish engulfing pattern between, except that instead of a pattern of 2 single bars, it's composed of multiple bars. And every time he gets to push and ease and sees this pattern, buys and sells, buys and sells, buys and sells. And I went back and I calculated, yes, on the stock market, it's not so bad. But if you're trying to trade CFD and forex with this, your spreads don't cover most of the trades, the buys and the sells he gets. But he calls it a sushi roll. because when the Symmetrical pattern shows in an downtrend, it warns us of a possible trend reversal. And this is the push up and then the engulfing pattern. And it warns of a possible trend reversal, showing that's a good time to look to buy or at least exit a short position. If it occurs during an uptrend, the trader gets ready to sell. Okay, now, it's all absurd. Believe me, I'm not endorsing this. In fact, I'm doing the opposite. I'm telling you, there's all kinds of crazy things out there to buy and sell on peaks and tops and peaks and tops. Okay, they're ridiculous. Okay, but if you understand the true movement of a trend and the true movement of what a retracement is, then you won't panic sell. And when you can determine or you set up tools to tell you that this is now moving into reversal, or you can identify that reversal because it's broken with lower lows, then you're ready to exit the market because you've now said, uh-oh, this is now a reversal, not a retracement, and you've gotten out of the market at the right time. So it's very difficult because there's lots of false signals. So even a retracement that meets all the criteria outlined in like our table one here that we started out earlier with, the best way to protect yourself against such a reversal is to use stop loss points. So this is how you could do it. You could estimate a retracement level using technical analysis and place your stop loss just below these levels. So in other words, if you saw a push up and then an ease, if you set your stop loss right below where you think that E should be, which would be above the trend line or above the support and resistance line or above the Fibonacci level, your stop loss would then trigger if you fell below it. And you wouldn't lose any of your profit. You might exit the markets too many times, but you would exit with a profit. Now, alternatively, you could place a stop loss just below the long-term support trend line or the moving averages. Ideally, what you want to do is lower your risk of exiting during a retracement while still being able to exit a reversal in a timely manner. So in conclusion, as a trader, you need to be able to differentiate between retracements and reversals. Without this knowledge, you risk many things such as exiting too soon and missing opportunities, holding on to losing positions and losing money and wasting money on commissions and spreads. So by combining technical analysis with some basic identification measures, you can protect yourself from these risks and put your trading capital to better use. So thank you very much for joining us tonight. Thank you for supporting TradeTime and Investing.com. And go set up a demo account at www.tradetime.com. And you'll see their charts, and they have some great courses on reversals and retracements. And they have very good courses on using Fibonacci levels and finding support and resistance. So have a good night and go to TradeTime, www.tradetime.com, and see all the tools that they offer you to learn all about this stuff. Have a good night now, and thank you for being with us.